Hello, everyone. I'm Carrie Delgott, Wescott's Chief Operating Officer, and I'm here with Mark McCarron, our Chief Investment Officer. Great to see you, Mark.
Hi, Carrie. Good to see you as well.
Mark, let's start off with a few of the headlines. Market participants have become increasingly concerned about the prospect of a recession as the Fed tries to cool inflation with a 75 basis point interest rate hike, which is the largest increase since 1994. Additionally, the markets are expecting a slowdown in economic growth due to a reduction in demand and consumer spending. And gas prices in particular have become a household burden, impacting expenses. Why don't you kick us off by digging a bit deeper into the Fed's recent actions and any of the other factors that are impacting inflation?
Yeah, I think that's important because inflation is the key, and it really comes from the most recent announcement, the CPI number that came out in May, which is 8.6%. So consumer price index is the main focus of the market, up 8.6% year over year. That was surprisingly higher than most market participants expected, and even the Fed expected. So what they did is they moved more aggressively than they even indicated a couple of weeks ago. The market expected maybe a 50 basis point increase in the Fed funds rate. Well, we got a 75 basis point increase. So just to put that in perspective, back in 10 years ago, back in 2012, we were still recovering from the last financial crisis in 2008, 2009. The Fed had kept interest rates at zero. But as a reminder, they started moving interest rates up 25 basis points at a time, all the way through until the end of 2019, where they reached almost 2.5%. With the pandemic, the Fed moved rates back down to zero. And that has been the driving force behind some of the market strength that we saw in 2020 and 2021. But this particular rise or increase in Fed funds rate really to tame inflation, being 75 basis point move, was the largest since 94, as you said, and much larger and much more aggressive than the Fed's been in many, many years. So that's driven some market volatility. And I think the Fed will continue to normalize these rates as the market conditions, as the economic conditions allow. But let's take one quick look at the drivers of that CPI number. So consumer price index measures the price increases of both durable goods and services. So goods, whether it be used cars or new cars or dishwashers, whatever you want to call it, that's the goods that we're buying. Services is more about travel, leisure, restaurants, that type of thing. And the last inflation reading that we saw was 8.6%, but it was pretty significantly driven by goods inflation. And that goods inflation is really the key driver for why the CPI was higher, why the Fed reacted the way it did. And what we're seeing is that there's perhaps, hopefully, we're seeing in the numbers, a peaking in that, sort of a topping out of the CPI goods number. And that would be a good thing for the market. So the supply side is contributing to this. So what we mean by that is that there's disruptions to factory workers, there's disruptions to shipping and access to these goods. Well, that may work its way through the system, and we might find CPI from a goods perspective continue to drop. That is a good thing because if prices do moderate, inflation expectations should drop, and that should provide a little bit of a break to the market volatility. And we saw evidence of that, in fact, in the last couple of weeks.
So, Mark, let's turn now to the markets. U.S. Treasury yields have increased with the 10-year U.S. bond yield hitting a multi-year high and the 2-year U.S. bond yield spiking above 3%. What should we take from this trend? And can you also talk about how the increased yields impact the stock market?
Yeah, as you mentioned, Carrie, the bond market has been responding, pricing in those rate hikes by the Fed. The orange line here is a 10-year bond yield. It's up about 3% for the first time since 2018. And the 2-year, the short end of the yield curve, has also increased pretty quickly, pretty dramatically, to also be above that 3% level. And I think a couple things, market participants look at the 10-year bond yield as a longer term indicator of growth for the economy. And a rising rate environment is a good thing generally for growth, but it also is pricing in perhaps a little bit of a higher inflation level going forward. The 2-year yield is very, very sensitive to Fed policy. So we just talked about how aggressive the Fed has been. The 2-year bond yield has gone up not just 75 basis points, but all the way up to 3% as well. So what does that matter? The yield curve, the difference between the 2-year yield and the 10-year yield, is flat. And typically when that happens, it's an indicator that the market is concerned about recession or a slowdown. And if that were to happen, that's where we're seeing the link to the stock market. The stock market's declining because there's a recession fear. They're reacting to the bond market. And by the way, the bond market's reacting to the Fed. And by the way, the Fed's reacted to inflation. So this is all linked together. And so inflation is the key. But that's what we're seeing in the bond market. The second thing I would say is the link between the bonds and the stocks is valuation driven. So, and you can see that in this picture. So what we're showing here is the valuation level of the stock market, the S&P 500. We're looking at things like forward price earnings ratios or dividend yields, price to book. But what we're showing here is the S&P 500 forward PE. And that was trading at 22 times earnings just about a year ago. It's now trading at 15.8 times earnings today. So I think that's a good thing. While prices have come down, earnings expectations have held up okay. And we're going to watch that carefully. But if that were to be the case, then the market is trading at a much more reasonable level of valuation than it has been in many years. In fact, lower than its 25-year average. So while the stock market is lower today, the valuation is more reasonable. And I would say the bond market is higher yielding, which is a little painful on the way up, but at least is giving us an opportunity to generate income from that portfolio.
Terrific. I really enjoyed the explanation of the linkage. That makes a lot of sense. As you mentioned in a few of our most recent webinars, and really throughout today's update, inflation is a key factor as we look ahead. So what does this mean for our portfolio strategy and outlook?
Yeah, I think just a quick reminder that the portfolios at Wescott are balanced. They're designed to provide those diversification benefits, particularly when markets sell off the way they have. And in particular, in this environment where rates are rising, inflation's rising, and growth stocks, which have been the driving force the last 10 years, they're the ones leading the sell-off. So the portfolios have benefited from being underweight the growth area of the market, the most expensive area of the market. And I think that's just a reminder that the portfolios remain balanced. The second thing I would say is that the stock market re-rating has brought these valuations back in line, perhaps more into more reasonable levels. And we're looking carefully at the earnings to ensure that they hold up and keep us where we need to be from a valuation standpoint. Inflation is the key. If some of these pressures that we just talked about ease a little bit, I think inflation headline numbers could moderate, which again would allow the Fed to be less aggressive or less hawkish. That would be a good thing for markets. Finally, the longer term, we're always looking at ways to improve portfolios. And so in June, global infrastructure as a component, as an investment style, was added to Wescott client portfolios via a fund called Lazard Global Listed Infrastructure. This is a strategy that invests in global companies with regulated or contractual revenues, and these are typically linked to inflation. So while inflation might be coming off its peak, we still think it's an important risk factor to consider, and the addition of global infrastructure to client portfolios is designed to mitigate some of that risk and participate in growth that's inflation linked. So that's really what we're thinking about inflation and the prospect for strategy going forward.
Thank you, Mark. Great update as always. If you have any questions or would like to discuss any of the topics we've covered in our webinar updates, please feel free to reach out to Mark or your advisor. And thanks for your trust in Wescott.